Hey everyone, and welcome to a super important topic in macroeconomics banking. Ever wondered how money really moves around, how banks create it, or who controls it all? Today, we're diving deep into the fascinating world of commercial banks and the powerful central bank. Let's get started. First up, commercial banks. Think of your local bank. That's a commercial bank. They do two main things: take your deposits and give out loans. But here's the magic trick. They also create money, a process called credit creation. Imagine you deposit $100. The bank keeps a small portion, say $10, and lends out $90. That $90 gets deposited elsewhere, and the cycle continues, multiplying the original $100 many times over. It's how banks fuel economic activity. Commercial banks accept deposits and advance loans across households and firms. Credit creation explained. Small reserves enable multiple rounds of lending. A key constraint is the legal reserve ratio, CRR plus SLR, which limits how much banks can lend. A person deposits money, banks gain lendable funds. A business takes a loan, spending circulates back as new deposits. That's the everyday engine of finance you interact with. Now, above all the commercial banks, sits the ultimate boss, the central bank. In India, that's the Reserve Bank of India, or RBI. Unlike commercial banks, their goal isn't profit, it's to keep our entire economy stable. What do? Well, they're the only ones who can print currency, they're the government's bank, and they're the banker's bank, meaning commercial banks hold accounts with them and can borrow from them if needed. They also manage our country's foreign currency, and crucially, they control the money supply. Key functions include bank of issue, banker to government, banker's bank and supervisor, lender of last resort, custodian of foreign exchange, and controller of credit. Together, these roles keep the financial system safe and efficient. So how exactly do they steer the economy? Through what we call monetary policy. Let's open the toolbox. How does the central bank control money supply? Through what we call monetary policy. They have a toolbox full of instruments. First, the quantitative tools that affect the whole economy, like the bank rate, which is how much commercial banks pay to borrow long-term from the RBI. If the RBI increases it, banks borrow less, and there's less money circulating. Then there's open market operations, where they buy or sell government bonds to inject or withdraw money. And don't forget CRR and SLR, percentages of deposits banks must hold. Increase these, and banks have less to lend. These ratios directly tighten or loosen overall credit. We also have the repo and reverse repo rates for short-term lending and borrowing. Then we have qualitative tools, like margin requirements on loans, or even just moral suasion, where they persuade banks to follow certain lending practices. Selective credit controls can guide credit to or from specific sectors. Quantitative, bank rate, open market operations, CRR, SLR, repo, and reverse repo. Qualitative, margin requirements, moral suasion, and selective credit controls. These tools are like the levers and buttons the RBI uses to steer our economic ship. By tightening or easing, the central bank stabilizes prices and supports sustainable growth. Finally, let's talk about money supply itself, how we measure the total amount of money in our economy. Economists use different measures like M1, M2, M3, and M4. M1 is the narrowest, including physical currency and demand deposits, the most liquid forms. M3 is broader, including time deposits. Understanding these helps us see how much money is actually available for spending and investment. Each measure gives us a different perspective on the economy's liquidity. So there you have it. From commercial banks creating credit to the central bank's powerful role in controlling it all through monetary policy, banking is at the heart of our economy. I hope this cleared things up. If you found this helpful, give us a like, share, and don't forget to subscribe for more macroeconomics insights.